Index funds versus ETFs, Battle of the Titans. Welcome back to the channel. Today we're diving into a hot topic, index funds versus ETFs. Which one is better for your investment strategy? Let's break it down. I get asked this question all the time. People want to know which is the ultimate winner, the champion of the investment world. But the truth is, it's not that simple. Both index funds and ETFs are fantastic tools for building wealth, but they each have their own strengths and weaknesses. So in this video, we're going to settle this debate once and for all. We'll go deep, exploring the ins and outs of each investment vehicle. By the end, you'll know exactly which one is right for you and your financial goals. Let's jump in. Decoding index funds, a beginner's guide. Let's kick things off with index funds. Now, an index fund is like a basket of stocks that tracks a specific market index, like the S&P 500. Think of it like a pre-built, diversified portfolio. When you invest in an index fund, you're essentially buying a tiny piece of all the companies in that index. So if the S&P 500 goes up, your index fund goes up too. Pretty straightforward, right? This makes index funds a popular choice for passive investors, those who want to grow their money over the long term without the hassle of picking individual stocks. It's like investing on autopilot. You set it and forget it. And the beauty of index funds is their low fees. Because they're passively managed, meaning there's no team of analysts constantly buying and selling stocks, they have much lower expense ratios compared to actively managed funds. This means more of your money stays in your pocket, working hard for you, and trust me, over time those lower fees can make a huge difference in your returns. Plus, index funds are super easy to buy. You can find them at most major brokerage firms like Vanguard, Fidelity, and Schwab. Just open an account, choose your index fund, and you're good to go. Now, some of the most popular index funds out there include the Vanguard S&P 500 Index Fund, the Schwab Total Stock Market Index, and the Fidelity Zero Large Cap Index. These funds give you broad exposure to the U.S. stock market, making them a solid foundation for any diversified portfolio. Remember, index funds are all about keeping it simple and letting the market do its thing. ETFs explained the cool kid on the block. Now let's move on to ETFs, or exchange-traded funds. These bad boys are like the cooler, more versatile cousins of index funds. See, ETFs also track a basket of assets, just like index funds. This could be anything from a stock market index to bonds, commodities, or even real estate. But here's the key difference. ETFs trade on stock exchanges, just like individual stocks. This means you can buy and sell them throughout the trading day, giving you more flexibility and control. With index funds, you typically have to wait until the end of the trading day to buy or sell shares at the net asset value. But with ETFs, you can jump in and out of positions whenever you see an opportunity. This makes ETFs a popular choice for active traders or those who want to make tactical moves in their portfolios. They're also a great option for investors who want to invest in specific sectors or themes like technology, healthcare, or renewable energy. And just like index funds, ETFs generally have lower fees compared to actively managed mutual funds, so you're still keeping more of your hard-earned money. However, it's important to note that some ETFs, especially those focused on niche sectors or strategies, can have higher expense ratios. So it's always crucial to do your research and compare fees before hitting that buy button. Some of the most popular ETFs out there include the Spider S&P 500 ETF, the Invesco QQQ Trust, which tracks the NASDAQ 100, and the Vanguard Total Bond Market ETF. These ETFs give you broad exposure to different asset classes, making them a great addition to any diversified portfolio. And because they trade like stocks, they offer more flexibility and trading options. Chapter 3: The Fee Face-Off Index Funds versus ETFs. Alright, let's talk money, specifically the fees associated with index funds and ETFs. Remember those expense ratios I mentioned earlier? Well, they can make a big difference in your returns over the long run. Generally, both index funds and ETFs have lower expense ratios than actively managed funds. Think of it this way: you're paying for the convenience and diversification they offer. However, there can be slight differences in fees between the two. Index funds typically have slightly lower expense ratios compared to ETFs. This is because ETFs have additional costs associated with trading on stock exchanges. But hold on, don't go dismissing ETFs just yet. Remember, they offer more flexibility and trading options. So, the slightly higher fees might be worth it for some investors. Here's a pro tip. Always look at the expense ratio before investing in any fund, whether it's an index fund or an ETF. The lower the expense ratio, the better. Another fee to consider is the trading commission. Most brokers no longer charge commissions for trading ETFs or index funds. However, it's always a good idea to double-check with your broker to avoid any surprises. Chapter 4. Flexibility Face-Off. Trading index funds versus ETFs. Let's talk flexibility. When it comes to trading, ETFs have a clear advantage over index funds. Remember, ETFs trade on stock exchanges just like individual stocks. This means you can buy or sell them throughout the trading day, giving you more control over your investments. This is especially useful for active traders or those who like to time the market. See an opportunity? Jump in with an ETF. Need to rebalance your portfolio quickly? ETFs make it easy. Index funds, on the other hand, are typically bought and sold at the end of the trading day at their net asset value, or NAV. This means you have less flexibility with your trading. But for long-term investors who aren't concerned with daily market fluctuations, this might not be a big deal. Another advantage of ETFs is that they offer fractional shares. This means you can invest in an ETF with any amount of money even if you don't have enough to buy a full share. For example, let's say you want to invest in the S&P 500 but you only have $100. With an ETF like SPY, you can buy a fractional share and still get exposure to the index. Index funds, on the other hand, typically require you to buy whole shares. This can be a barrier to entry for some investors, especially those who are just starting out. Chapter 5. The final verdict, choosing your champion. So, we've covered a lot of ground today. We've explored the ins and outs of index funds and ETFs. Now the million-dollar question, which one is right for you? Well, as with most things in personal finance, the answer is, it depends. If you're a long-term passive investor who wants to keep things simple and low-cost, index funds are a great option. They're like the reliable workhorse of the investment world. Set it and forget it. But if you're a more active trader who wants more flexibility and control over your investments, ETFs might be a better fit. They're like the nimble sports car of the investment world, ready to move when you are. Ultimately, the best choice depends on your individual investment goals, risk tolerance, and time horizon. Here's a quick recap of the pros and cons. Index funds pros: low fees, diversification, simple to understand, great for passive investing. Cons: less trading flexibility, typically can't buy fractional shares. ETFs, pros: more trading flexibility, can buy fractional shares, offer exposure to various asset classes, lower fees than actively managed funds. Cons: can have higher expense ratios than index funds, more complex than index funds. No matter which option you choose, remember to do your research, invest for the long term, and stay consistent with your contributions. Happy investing! Index funds versus ETFs. The choice is yours. Thanks for watching. If you found this video helpful, make sure to hit the like button and subscribe for more investing tips and insights. Let me know in the comments which you prefer: index funds or ETFs. See you in the next video. Remember, investing doesn't have to be complicated. Whether you choose index funds or ETFs, the most important thing is to start investing early and stay consistent. Now go out there and make those money moves.